Good afternoon, everyone. I hope you're all doing well. So today we're gonna proceed with the questions and problems at the end of the chapter. You can see it, like we have already covered chapter risk of the financial intermediation. So we just gone through overall all of the risks that may face the financial institution during its day-to-day activities. So we're gonna proceed starting with the question 1 and so on. So if you don't have any questions, I shall start then. Concerning question number 1. What is the process of asset transformation performed by the financial institution, and why this process often leads to creation of the interest rate risk, and what is the interest rate risk itself actually? So basically, asset transformation by financial institution involves purchasing primary assets, and once it purchased the primary assets, then it issues it in the secondary assets as source of funds. So the primary securities that are purchased by financial institution often have maturity and liquidity characteristics that are different from the secondary securities that are issued by the same financial institution. So for example, a bank may buy medium or long-term bonds that we discussed, like 2 years bond or 5 years bond, and makes a medium long term with the funds raised with the short-term deposits. So buying and selling, this is the difference where the banks actually they're earning their profits, like interest earnings, like lending and borrowing. This is the difference, they make a profit. So this is called as a process of asset transformation. So you're transferring your assets, let's say you're transferring your deposits into the assets. Your deposits are 1 year, and when you sell it, these same bonds, but for 5 years. So this creates a differentiation in maturity and liquidity. So interest rate occurs because the price and the reinvestment income patterns of the long-term assets are directly different from the market interest rates and from the issuance rate actually. So basically, interest rate risk is the risk that occurred or incurred by or faced or exposed by financial institution when the maturity of its assets and liabilities are not properly matched. So the main idea of the financial institution, the main goal of the financial institution, not to have interest rate risk, they should have their assets maturity be equal to the liabilities maturity. This is the main goal of any financial institution. So this is the first question. The theoretical question I'm gonna just discuss. I'm not gonna write anything because it's been recorded. If there is somebody who cannot properly get what I'm talking, he can just go over again the recording. But when it comes to the calculation, I'll put some numbers in here, okay? Question 2. What is the refinancing risk, and how the refinancing risk as a part of interest rate risk? And if a FI funds long-term assets with the short-term liabilities, and what will be the impact of earnings of an increase in the interest rate, and what will be the impact of decrease in the interest rate? So let's discuss about what is the refinancing risk itself. So refinancing risk is the risk that the cost of reborrowing funds will go up above the return that is being earned on the asset investment. This is what we discussed already. And this risk occurs when the financial institution is holding assets with maturity higher than the maturity of its liability. So assets maturity is higher than liabilities maturity. This is when the refinancing risk is taking the place as interest rate goes up. For example, if the bank has 10-year fixed rate loan and buy 2-year time deposit, so we collect the deposits and we give 2 year, and we provide the loan, but we give 10-year. You see that difference? It's 10-year and 2-year. So this is all question 2 we're discussing. Just an example. The bank definitely will face a risk in a new deposits may only be obtained and the loans refinance at higher rate in 2 years. So this interest rate increase would reduce the net interest income actually. Because for you to give, if the interest rate increases, in this case, you have to pay more deposit rate. However, you already provided the loan at lower interest rate, and definitely it will impact your net interest income. And how it works in real example with the numbers, we're gonna see it a little bit later. So this is the case of refinancing risk. However, the bank would benefit if interest rate falls, because as cost of renewing deposit would decrease, while interest rate earned on loan would not change. So if we, let's say, provide our loans for 10%, and this is 5% before, and now the interest rate falls to 2%, and we are still providing at 10%, but we should have already reduced it if we had borrowed a new loan, if we had lent a new loan, but we're still keeping the cost of lending high. So that makes us to earn money as a bank if we put ourselves into the shoes of the financial institution. This is we call a refinancing risk. In a refinancing risk, as interest rate increases, that makes the bank to go into trouble because the maturity of the assets is higher than maturity of the liability, because 10-year loan and versus 2-year time deposits. This is what what we know about refinancing risk. Let's go with the third question. This is down, down, and the third question. Do you have any questions, guys? Please, if you feel that you cannot understand, just stop me and I will go over again. So these things that we have already discussed, I don't think that we need to pay attention more into definition, but I'm just quickly giving this explanation of reinvestment risk so for you to understand better. So in here, basically asset maturity is greater than liability maturity, and the banks suffer when the interest rate goes up. So the banks will suffer, the banks will be in trouble if interest rate goes up. But when it comes to the reinvestment risk, is the risk that the return on funds to be reinvested will fall below the cost of funds. So it is the opposite of the refinancing risk. This occurs when the financial institution holding the asset with maturity that are shorter than their liabilities. So in here, we have assets maturity are shorter or lower than the liabilities maturity. For example, if bank has got 2-year loan funded by the 10-year fixed rate time deposit, so it's just opposite. It was 10 to 2, now it's 2 to 10. So 2-year of assets to 10-year of time deposit. Do you have any questions, guys?
Oh.
Please feel free if you've got any questions. So in here, the banks will be in trouble if interest rate falls. Okay, this is the main part. This is the definition of reinvestment risk. So in here, we are benefiting if interest rate falls. In here, we are benefiting if interest rate is going up, because we have refinancing risk and reinvestment risk. Okay, so far is clear about 3 questions. Now let us move to the question number 6. Okay, we are having the question number 6. It's a good question. Question number 6. given a balance sheet structure like cash, bond, total assets, certificate of deposit, equity, and so on. So let's go with the A. The bond has 10-year maturity of fixed rate 10% paid at the end of each year with a par value of 10,000. The certificate of deposit has 1-year maturity and interest is 6% with fixed rate. If I expect no additional assets growth, what will be the net interest income at the end of the first year? Net interest income equals to the net interest income minus net interest expense. So we need to have a situation here. This is 10-year. This is 2-year. If I'm not, let me just, no, 1 year. This is 1 year. So 10-year maturity and 1 year. So what do you think? What kind of problem you have? A refinancing risk or reinvestment risk?
Refinancing risk here.
Very good. Why? Because the maturity of the provided assets are higher than maturity of the liabilities. Very good. So what is the bad consequences that we should expect here? Increase or decrease of interest rate? So when what we should be afraid of in refinancing risk? When the interest rate rise or decrease?
Rise.
Yes.
Increase.
When the interest rate is going up, this is the thing that makes us to worry about it, because the cost of borrowing of new collected deposit will be higher, and we already gave in for 10 years. So this is what we're further. So what will be the net interest income at the end of the first year? Let's calculate the net interest income. So our interest income is equal to, let me just type. So we said that the bond value par is 10,000 times 10% will give us the interest income for the bond, which is how much money we earn. Let me just type, this is bonds. This is we provided, okay? And this gives us $1,000. And certificate of deposit is equal to 10,000, but with 6%, which is equal to $600. So our net interest income is equal to interest income minus interest expense. This is what we know from the formulation. That will make us 1,000 minus 600, which is $400. So our net interest income $400. So we are not calculating the risk in here. We're just calculating the net interest income. Why we are doing so? We need to see what will be the effect if the interest changes for the part B and C. Let's see what's going to happen. Okay, I'm just going to put it up. This is R. Okay. Now, this is for A, okay? Now let me go for part B. This is A. We already calculated it. It's just straightforward. There is no problem with this. I think, yeah, everybody knows how to calculate the interest rate. It's just principle. It's a simple of calculation of the terms of there is a bond value, which is 10,000 and 10%. There is a certificate of deposit, 10,000, 6%. That will give you 601,000. Net interest income is net interest income minus interest expense. So net interest income is equal to 400. So part B, if at the end of the year one, market interest rate have increased by 100 basis, 100 basis, which is 1%, okay? What will be the net interest income for the second year? So guys, before calculating, do you think that we are having that net interest income will go down or increase if interest rate increased here?
It will go down.
Because why? We are in refinancing risk, yes? We are facing refinancing risk here. That's why increasing interest rate should make your net interest income to go down. So net, let's calculate the interest income. What will happen to net interest income? What will be the bond interest? Does
1,000.
Bond interest doesn't change, yes? We already lent it. We already given this loan. We cannot change because there's an agreement. It will be 10% and we cannot make any changes. But certificate of deposit, CD, will be equal to 10,000 times. Our interest was 6%. Now it becomes 7%.
I'm sorry, I have a question.
Yes, please.
But it said that the certificate of deposit is 1 year maturity. Does it mean that it was expired in the last year?
Yeah, it's expired in the last year. Now we are getting a new certificate of deposit. We are collecting new money.
Oh, okay, okay.
This is new money. That's why this is the problem, actually. I mean, refinancing risk. We cannot refinance at the same cost that we used to refinance last year. So today's refinancing will be higher because interest rate increased. That will be $700. So our net interest income will be equal to 1,000 minus 700. So as our friend mentioned, that net interest income falls down. And this is a problem of refinancing. Refinancing risk. So let's move further. Assuming that market interest rate increased 1% and the bond will have value of 9,446 at the end of the year one. What will be the market value of the equity of FI? Look, change in the interest rate, it does not only affect the interest, it affects the market value of the bond. So the bond value is deteriorated as well. So do you know how to calculate the bond value? So it's calculated in here, but you have to know there's a formulation which is given like coupon payment times, big formula, 1 minus 1 over YTM divided by YTM to the power T and close the brackets and so on. There's a big formula. We're going to come to that point as well. But in this example, it's calculated. So if the interest rate was 6%, and the bond value is equal to this, and here the bond value is deteriorating because 1% increase. So what will be the market value of equity then? We need to calculate what we need to kind of reevaluate the bond value condition. What will happen to the bond value? So we know that the cash is 1,000 and bonds, it was 10,000, but now 9,446, and that makes total assets equal to 10,446. So what happened to the total asset? It reduced, it deteriorated because the bond value deteriorated. And of course, our certificate of deposit doesn't change. As it was 10,000, it is 10,000. What is changing is our equity. Equity. Our equity was, how much it was? Let me see, 1,000. Okay, it was 1,000. Now it becomes less than 1,000. It becomes only 446. So you see how much our equity, because when this deterioration happens, who is suffering? Depositors or bank? Imagine bank, because if you put deposit 10,000, imagine you put your money to the bank, okay? 10,000, you put for 1 year. If something goes with the interest rate, imagine the Halyk Bank tells you, sorry, you are losing your deposits because there's a reduction in interest or increasing in interest. Will it be fair for you?
No.
No, because you are given a guarantee that you put the money and you should receive whatever you put. And you put for interest, you have to earn on that. So whatever the interest happen, increase or decrease, it is the responsibility of the bank. So whatever losses happens, the bank takes that losses. And this equity represents the bank's part, the bank's participation part. So it was 1,000 and it's deteriorated. So it's deteriorated by, I think, $554. So total liability plus total equity is equal to $10,446. So this is the picture of the new balance sheet. This is the old balance sheet, but now is the new one. So the loss in the bonds, that means you're not losing, the market value of the bond is deteriorated. If the market value of the bond increased, let's go at a vice versa position. So it's part D. Part D. If market interest rate had decreased by 100% basis points at the end of the year. So if reduction happened, so what the market value equity, higher or lower than 1,000? So your answer?
Higher.
Higher, because there is an inverse relationship between the bond value, yes,
and interest rates.
So what will happen to our new balance sheet in here? It will be not 9,000, but it will be
much bigger
1,000,
than
10,554, if I'm not mistaken. Let me just recheck. Just a second. 900 and... Yes, true. So our new total asset will be equal to 11,554. And by how much our equity will increase? By 554. So our equity will be $554. Okay, great. You are getting me. That's perfect that you're following me. So this is how it looks like. Now you got what is the refinance risk is. So when the interest rate goes up and when the interest rate goes down. So in this case, the interest rate goes up. In here, the interest rate goes down. This is how we benefit. And what will be in here? We are not asked to calculate net interest margin, but net interest income is equal to interest expense minus interest. So our first interest income will be 1,000, doesn't change, is the same, but interest expense will be changing. Our interest expense will be 5%, isn't it? Because it was 6%, now it's reduced to 5% by 100 basis here. So 10,000 times 0.05, and in total you have $500. Is there anyone who doesn't understand where do I get this 5%? Our interest was 6%. we're not asked to calculate, guys. We're not asked to calculate here this calculation, but you're asked to just answer verbally. But in here, I just calculated just for you to show how it affects our results actually. So like kind of clarification mathematical. So 6% interest was 6% and falls to 5%. It says it decreased by 100 base by 1%. 100 base is 1%, okay? So this is how we get the net interest margin, net interest income. Okay, let's move to another question. What factors have caused the changes in operating performance and market value for this firm? What factors have caused the changes in operating performance and the market value of the firm? Any idea?
Change in
Interest
cost
rate.
of borrowing and lending.
So basically,
Interest rates.
yeah, very true. The operating performance has been impacted by changes in market interest rate that have caused corresponding changes in interest income and interest expense. And at the end, it changed the net interest income. So these specific changes have occurred because of the unique maturities of the fixed rates and variable rates in liability. Why it's a variable? Because every year changes. Like we're getting a new certificate of deposit, but with maturity 1 year. That is why it's considered to be a variable.
Sorry, Professor, can I ask a question?
Yes, sure, go.
Could bank potentially have its asset maturity exactly the same as its liabilities maturity, so that in order to eliminate interest rate risk, or
Very
not?
good, very good. This is what you have come. You asked me the question and you provide the solution to the problem. Very good. This is the actually strategy that is used nowadays by bank, that is applied in order not to face the interest rate risk. Why? In order to keep your maturity of asset equal to the maturity of the liability. Still, they cannot fix it for 100%. At least 90% of their asset are matched with the liabilities. If you manage to, so as a financial manager in the financial institution, this is the strategy should be used in order not to have an interest rate risk. It was the question by you and it was the solution actually. Because your problem is changes in the interest. You don't know in what way the interest will go. It can go up, it can go down. So for you not to put yourself into risk, because you cannot risk with the money of the customers. So that's why otherwise you're gonna incur the loss by yourself. So that's why you decided to keep balance the asset and liability side. Okay, this was the questions that we answered. Okay, let me just save this screenshot. If you don't have any question, I'm moving to another one. Your question, it was really nice question and it was on time.
Okay,
So,
thank you.
and it is the kind of bank strategy and they're always trying to do this, but it doesn't necessarily mean they're managing it, but at least they're trying to reduce the risk. Okay, let us move. Okay, we're not gonna do this. No. Okay. So these things like, what is the market risk and how does it affect the operating performance of the financial institutions and so on. This is all stuff you know. So what is the... So let me go with this question. So a bank invested 50 million in 2-year asset paying 10%. per year and simultaneously issued 50 million 1-year liability paying 8% of interest year. So the liability will be rolled over after 1 year at the current market price. What will be the bank's net interest income if at the first year all interest rates have increased by 1%? So by 100 basis. So we need to calculate what will be the net interest income in year 1 and net interest income in year 2. So how we do it? It's just straightforward. What did it before? Yeah. So interest income let me put it in this way. Year 1 interest income is equal to, so 50 million with a 10% will make 5 million, and your interest expense is equal to, interest expense, the liability side, 50 million with 8%, which is 4 million. And our net interest income or net interest margin will be equal 5 minus 4, it is 1 million. It's just straightforward, you know how to calculate. And in year 2, look, it's 2 years and this is 1 year. So 2 years against 1 year. So our variable rate will be changing for liabilities only. So there is a 100% increase in the interest rate. That means that our, let me just copy this to make quicker. Oops. Oh my gosh. This is first year. Let me do it like this. For second year. So if it's interest increased, let's say by 1%, 1% increase. That makes our interest income same, but it changes our interest expense. So our interest expense will be equal to 4.5.
4.5.
Yes, very nice. And our definitely net interest margin or net interest income will be reduced to 500,000. It will be $500,000. So you can see just 1% change of interest, how much it affects the profitability of the bank. Just 1%, it's 100 basis. This teeny change, it affects totally. So this is question 12. Question 12. I'm saving it. If you don't have any question, I'm erasing it. Okay. Okay, now we're coming, what is the market risk? We already discussed about it. I don't have to pay attention to it. Credit risk. So credit risk is the risk that promised cash flows, future cash flow from the loans and securities that is held by financial institution will not be paid in full amount or will not be paid at all. This is what problems they face the credit risk, and this was the main issue during the credit crunch. So there is another question, what is the difference between firm-specific credit risk and the systematic credit risk, and how can financial institution alleviate the firm-specific credit risk? So the firm credit-specific risk refers to the likelihood that the single asset may deteriorate in quality, and while systematic credit risk involves macroeconomic factors that are not controlled by financial institution, that may increase the default risk of all financial institutions in the whole economy. So basically, the very specific credit risk, the thing that you can control as a financial institution, because it's like you're dealing individually with your own assets. But when it comes to the systematic credit risk, it comes as a market failure, so which is not controllable by financial institution. Now, let's go further. Let me choose a good question for you. The one that is a really good one. So let us go with this question, which is foreign exchange risk. Question 25. It's a good question. Actually, you can solve at home all of the questions, but they're more or less the same, but I'm choosing only like which are more or less is good questions. So 6 months ago, Equality Bank Limited issued 100 million one-year maturity CD denominated in euros. So they collect the deposits in euros, we can say. On the same date, they issued $60 million was invested in euro-denominated loan, and 40 million was invested in US. So Treasury bill. The exchange rate on that date was 173 for dollar, and assume no repayment and principal. The exchange rate today is equal to this value. So it was this, and now it becomes this. So what is the current value of the CD principal in dollar terms? So what we need to do, we need to just multiply with this following exchange rates. So what we do here, let me just put it here, okay? Our first question. Part A. So CD denominated in euro, they're asking what is the current value of CD principal in euro and in dollar. So in euro, because it was saying that $100 million was invested in euro, and that date when it was invested, when it was issued, the exchange rate was 1.73. So our euro value of CD euro is equal to 1.738 times 100 million. That will give us 173.8. This is 82 million of euro. And B, sorry, not the B, but CD in dollar. CD in dollar. $100 million. So let me read the question again because I might not be. What is the current value of the CD principal in dollars? What I'm doing here. 173.82 millions of euro CD, and in terms of dollar, it should be taken into consideration this rate for the currently. So if you calculate 173.82 million divided by 1.3905, it is 125 million of dollars. How did I come up with is exchange rate like 173.82 when we issued CD deposit certificate at this rate, and then we are converting back to our dollar, how much it's appreciated, because look what happened to the value. So we're getting back to its dollar. So we're dividing by 1.3905. So this is how we get CD value, current value, guys. Let me correct value in euro and dollar. Okay, just like this. B. Okay, let's go for B. So look, this is when we issued our CD certificate, $100 million we purchased in terms of euro. Then we convert for the current year, current rate for each euro. So this is how much we get it actually. So in here, what it means for $1, how much euro is paid? Okay, nowadays is different because the book is, I think, 2012. And even in that way, but in here they mentioned in the way that euro is higher than the dollar. So the higher euro paid for $1. Okay, do not mix it up. And for second one, what is the current value of the euro denominated loan principal in dollar and euros? Now we need to calculate the euro denominated loan. So first we were counting how the exchange rate affected liability side. Now we want to see how the exchange rate will affect the asset side. So the current value, the euro denominated loan, in euro and dollar is equal to in here we invested $60 million in euro denominated loan and 40 million was invested in US Treasury bill. So $60 million in euro times, let me just time 1.60 times 1.7382. So we get 104.292 of euro. How did I get it? I got like 60. If you have question, please do not hesitate to ask.
So why did you multiply by the first rate, not the second?
Because it was the rate on the date was actually when we invest. And this is today's rate, okay? 1.73 is investment rate or issuance rate, we can say. And today's interest rate is this, so the exchange rate is this one.
Okay.
And this is how much we got in euro. But if we convert the same amount for dollar, what we get is 104
35 million.
divided by 1.3905, $75 million. How did we get it? We just 104.292 divided by 1.3905. I hope everybody got the logic, how to calculate and how they got the benefit, okay? And now we calculate, so what is the current value of the US Treasury bill in dollars and euros? So we calculated for, and we know that 40 million was invested in Treasury bills as well, okay? Now, let's see how the T-bills. So we have here $40 million invested in US Treasury bills. So look, 40 million, which means that we have not done anything with it, okay? $40 million is still remaining. That in dollar, we invested in dollars. So Treasury bill in dollars, it is 40 million. And in euro, it becomes, tell me guys, do we earn anything from here as a bank? From this 40 million in exchange rate?
No, I think no.
Yes, very good, because we have not invested in euro. Why should we earn anything? So 40 million is 40 million in dollars. And in euro, we are just multiplying with the current rate. It's 40 million times by 1.3905 would give us 1.3905 times 40. It's 55.66 million of euro. This is for T-bills. Okay. And what is the Quality Bank's profit loss from this transaction in terms of dollars? Is there anyone who can tell me and calculate the profit transactions and loss? Profit or loss is equal to, think a bit.
From which transaction?
From all transactions. Some money we invested in liability, in millions. So this all ABC. So what we have,
okay.
the rate was 1.7382 and then rate changed to 1.3905. So what happened? Dollar depreciated or appreciated? Look, before you were paying for $1 1.7 euro, now you are paying 1.3 euro. So euro is
depreciated.
Wait, be careful. Euro is appreciated. Depreciation means when it loses its value. Now, before you have to pay more euro, but now you are paying less euro for $1. Dollar is depreciated, but euro is appreciated. So think bits. I'm giving you like.
Isn't it inverse?
No. Now it's in reality it's in inverse, but in this example it's showing that it's a like US book, and they're thinking that for dollar they have to pay more euro, but in reality now you are paying more dollars to euro. That's true. But in this case, the euro is appreciated because it's gained. Now look, for $1, how much a euro you have to pay? Let's put in a rough example. Like for $1, you pay €2. $1. But when it comes that you're gonna pay €1 to $1, what does it mean? Your euro appreciated, or make it not euro, make it tenge to good comparison. Tenge was 425 and now it is 100 tenge. So what happened to tenge? Appreciated or depreciated?
Appreciate.
So same thing with the euro. I'm giving like, I will keep like 1-2 minutes and I'll let you go, guys. Think, just give me an idea how to calculate the profit and loss. Here, you invested, example here, you invested $100 million in liability, certificate of deposit, like you call it, issued certificate of deposit for $100 million. Okay. With 1 year maturity, CD denominated in euros, but that means that you have to convert this 100 million to dollars, sorry, to euros. And while you convert it, your euro is appreciated. But when it's appreciated, when you pay your certificate deposits back, you have to pay in dollars.
So there is a loss of 25 million? Or no?
Very good. Very good.
And also maybe we have profit from euro denominated loan.
Okay, let's go. How do you calculate?
So for the CD, I took $125 million minus 100, and I got minus 25 of loss.
For CD, 125 minus 100, it's 25. Okay. For loan, how did you do it?
I took $75 million minus 60, and I got 15 million of profit.
Loan. $75 minus 60. 15 million. And what is your loss?
$10 million loss.
10 million loss in dollar or euro?
Dollar.
10 million loss in dollars. Very good. Very good. So these are the dollars amount. That means that you really got the things. Okay, this is in dollar, but in euro, it will be 10 times 1.39, which is 139, 13.9 million in euro. This is in dollars. Okay. This is how you calculate the profit and loss when there is a foreign exchange risk take the place. So you calculate CD, this is liability side, and this is asset side. Okay. If you don't have any questions, thank you so much for your attention. That was all today. Thank you so much. Let me save it.
Oh, sorry, I have a question.
Yes, please.
In problem 6.E,
6. Yeah. What factors have caused the changes in operating performance and market value? Yes.
What was the answer? I didn't hear it.
So the operating performance has been impacted by changes in market interest rate and have caused changes in not only the market value, but it changed as well. As you can see from the solutions, what we did in here, it was, we saw how interest rate, net interest income changed and the market value is deteriorated. So the operating performance and the market value for the firm changes as the interest changes. Operating performance is proxied as net interest income because operation of the banks are based on the interest rate. So as the interest rate changes, the operational performance side of the banks changes as well. Additionally, the market value of the holding those assets has changed as well. What happened as deteriorated, like here, I just make a screenshot in here. I'm gonna just share with you as well here to remind you. Here, so the market value changed. It was 11,000. Now it's 10,446 plus the net interest income changed. Okay.
Yes.
Did I answer your question?
Yes, thank you.
Okay. If you don't have any questions, guys? If you don't have any questions, thank you so much. See you tomorrow.
Thank you. See you.
Thank you.
Bye.
Goodbye.
Bye.
Goodbye.
Bye.